if I were to get this correct, is advising people not only on investing, but taking in the tax consequences of those investments. Is that an accurate description?
Yeah, I mean, we're providing holistic financial planning, and investments is one piece of that. But there's a tax aspect to, every sort of, whether it's the life events or throughout the year. So it's a super busy time for most people. They're frantically trying to file their taxes, and oftentimes people like myself, are asked, okay, well, how can I lower my taxes? And the answer is you can't really do much right now.
Right, you're a little late.
Yeah, tax planning is really a year-round sport, and so whether we're discussing ideas this summer for the following tax season, or running scenario plans in the fall before implementing, it's really a year-round issue.
I want to share something. You were on a podcast recently, Getting Results with Dr. Gene, where you were asked a great question, which is, when should someone consider coming to someone like you? And here is what you said in that podcast. And on the other side of this, I'm going to let Kevin pick it up. So let's roll that soundbite.
It behooves business owners to find the right person that can give them that objective advice. And I think, there's a tendency oftentimes, in a lot of businesses, right, where, to hammer everything's a nail, right? And so, oftentimes some advisors, like their goal is like, hey, I want to manage the 401k, or I want to sell you some life insurance for your buy-sell agreements. And, that's just not good, objective, comprehensive planning, right? You just kind of have to look at everything.
Kevin, take it away, because you got to look at everything.
Absolutely. David, I'd like to ask you two questions as an expert in this field as it relates to financial planning and the impact that taxes can have on a financial plan. First, for your investors that are in a higher tax bracket, are looking for a consistent stream of income in their retirement to help offset the loss of income from their working days, but don't necessarily want to pay a lot of taxes, are municipal bonds a good way to approach that type of investor? And two, tax loss harvesting, which I think a lot of financial advisors don't speak often enough about, ways to minimize your tax burden without actually leaving the stock market altogether by employing tax harvesting techniques. So would you mind touching upon municipal bonds and tax loss harvesting?
I'll jump into tax loss harvesting first, because I think this is a concept that many people understand, right? And often most investors are, looking at this towards the end of the year, where you can take a loss in investment, stay out for 31 days, go back into it so you avoid the wash sale rules, and then apply that loss to a capital gain, and potentially even apply up to $3,000 of income, and then any sort of excess gets rolled over to the following year. But what I do think people should take advantage of is, think about doing their tax loss harvesting throughout the year.
That's right.
So every time there's a pullback, and with so many people in index funds nowadays, that there's opportunities to say, hey, instead of sitting it out, for 31 days and repurchasing it, well, maybe you take the tax loss right away, you buy something very similar in the index world, and then you ride the upside from there. And then you just build those capital loss, because even if you own your own home and you're going to qualify for the $500,000 homeowner exclusion, or, there's eventually you're going to need these tax losses. So I think that people at the very least should almost have a $3,000 deduction for the rest of their life, right?
Right.
And so, Wall Street's always very creative, right? Because now there's strategies where you can kind of recreate the index funds with a basket of 200 or 300 stocks. And so through algorithm trading, they can tax loss harvest that every minute of the day, step out of Pepsi, go into Coke, go back into it 31 days. And so there's limited tracking error in that index. And so this is a great strategy, particularly, if a business owner is going to sell their business in, 3 to 7 years, maybe outside of their business in their liquid portfolio, they should be taking those losses and building them up in anticipation of that sell.
Makes a lot of sense.
Yeah, and munis, I'm a little biased. Right out of college, I spent 8 years as a muni banker, and so for the right person, munis are great, right? Because I think that, and it's kind of interesting because the municipal market is very technical, right? Because the principal payments are largely January, July, or December, June, and so when cash comes in and all of a sudden it needs to get redeployed, and you're going to bid up those bond prices. And so that's when you don't really want to buy them. But when you do want to buy them is when people are liquidating their bond portfolios around tax time. And so there's some sales typically around this time of year. But we have to also remember that it's going to be very efficient at the short end of the curve. So if you're buying very short munis, it's just going to be 1 minus the highest tax rate, and that's kind of the yield you're going to get. Whereas you can get greater after-tax yields if you go further out up the curve, but then at the same time, you're taking more tax risk at that time. Right?
Let me ask you, David, real quick. I just want to remind, because we have growing viewers on X, that they can ask questions. You can put your question for David or for Kevin or for our other guests into the Twitter feed, and then we will make sure that we ask David Wilson your question. I want to pick up a follow-up on the muni question, because I don't have the kind of skill that the two of you have. I wish I could tax harvest, because hypothetically, let's say you knew a TV guy who left the media business and put 50 grand into a startup, and then that went belly up when it got sold to another company.
Are you sure that's hypothetical, Adam?
I turned 50 into 9 grand. I know how to make some money there for someone else. But here's my question to you about munis. I covered Puerto Rico back in 2016, 15, when there was real potential for default on muni bonds. And it wasn't just Puerto Rico. There were states where their muni bonds were going to be in trouble. And I'm wondering, David, the tax advantage might be there, but are they still a safe investment, especially in the current economic situation? Because I don't think the federal government's going to bail out any state whose munis or municipality, like Dallas had an issue with muni bonds. I don't think anyone's going to step in to save them.
Credit matters, right? And so I think that, as people are diversified, or you can either be very diversified or you do very diligent credit work, right? And so in general, where are your risks, right? Yes, you have a lot of risk in the most levered island in the world, Puerto Rico, potentially on the hospital side, just sort of speak generally. And I think that people kind of look at, okay, well, maybe I look at the different sectors and what the default rates are in the different sectors. Higher education, for example, has historically at least a low default rate. If that free equity comes on the balance sheet, as you issue bonds for, you can buy bonds for, Duke University or MIT or whatever the school is.
Sure.
And so, credit matters. Even for people, clients that we have are in New York State and New York City, we're going to be buying bonds outside of those locations because, just to diversify and buy bonds in sort of in communities and states with surging demographics, and so that way we're protected a little bit there.
David, just want to remind everybody too that we've got Bob Elliott standing by. He's going to join us momentarily after the break. But real quick, when your clients come to you talking about tax strategies, you mentioned this when you first started talking with us about you should have a different tax strategy at different points in your life. So let's address people who might still have kids at home who haven't gone yet to college. How would you advise that person, whether they're an entrepreneur, whether they're a business owner? How does that strategy differ than someone like me who's looking towards, exiting the work world in the next 5 to 10 years?
So there's a host of strategies depending on what it is, right? So I think if there's investments in real estate, there's strategies to sort of purchase, manage, and sell real estate, whether it's 1031s or cost segregation. Entrepreneurs, of course, many of them are running more than their share of personal expenses, for example, through a business. So that finding what's ordinary and necessary and running that through to lower their tax rate is super important. For parents here in New York, for example, you can do a $10,000 contribution to a 529, and that's state deductible. There's different strategies when it comes to, if people are kind of having kids, hiring them in the businesses, whether that's for modeling on the website, funding those Roth IRAs, all sorts of different strategies, depending on what their situation is. It has to do with, talk to your advisors, your CPA, your financial planner, and kind of think about, okay, well, what's most appropriate for you in each situation. So.
Kevin, you got one
Because
more?
a general rule of thumb, Adam,
Yep.
most people don't like to pay taxes or pay minimal taxes at all times, though.
You know what? Let's do this because I know I've got Bob Elliott on standby. And David, we're going to bring Bob Elliott in for a discussion with us, but you're not going to go anywhere. You're going to be here. We're going to bring you back after we talk one-on-one with Bob because you might have some questions for him with his investment strategies, and he might have a question for you about how do you tax protect those investment strategies. So we're going to take a break. I want to let the roughly 800 people watching us on X know you can ask David a question, you can ask Kevin a question, you can also ask Bob Elliott a question. He is on deck, and we'll be back in 30 seconds. Welcome back to Talkenomics Live. Our guests this evening are people who understand investment strategies, the tax implications, and you get to ask the questions. That's my way of reminding the over 800 people on X, the people on YouTube, that you can ask questions simply by putting your question into the chat comment section, and we will make sure that we get to those. And as I bring Kevin Mon back in, who's helping me, one of the reasons I brought you in, Kevin, is because, as you just saw with David, I need someone who understands how to execute a tax harvesting strategy, because I've never done it and probably should have, but oh well, that's money gone. But the next thing, you remember when I left media and I went into alternative investments? Do you think I made a bad mistake going into alternatives? It's my setup for our next guest, but what do you think?
Alternative investments need to be considered as part of any diversified portfolio right now. It does depend on the type of investors and what their objectives are. Your case was very different because the product in the area of the market that you went into was a good area to get into. In fact, every time I speak at an industry conference across the country right now, it's about AI, whether it's alternative investments or artificial intelligence. Perhaps the manner in which you went about going to address that field didn't work out well for you, but alternative investments are certainly at the forefront of most investors' minds right now. They don't understand them. A lot of financial advisors don't understand them, and both would be wise to listen to our next guest to learn a little bit more about them and how they might be able to use them within their own portfolios.
And that is the setup to bring in Bob Elliott. Bob Elliott, who is the founder of Unlimited, and who I just got to say this because you should be shouting to the hilltops. You were the right-hand man to Ray Dalio, and I would love to get you a cup of coffee. What is he like in person? And ask you that question. But the people joining us now, we're going to talk more than just AI and machine learning. But you were kind of ahead of the curve in that regard because you were using machine learning to help make investment strategies more affordable than someone like me who has buddies on Wall Street who are 2 and 20 hedge fund folk and would charge you whether they made money or not. So what are you doing now? And are you still using machine learning as part of your investment strategies?
Yeah, I mean, I spent my career, as a 2 and 20 manager, and increasingly recognize that, 2 and 20 managers and 2 and 20 strategies, they're pretty good for the manager and pretty bad for the investor. And the primary reason why that is because the fees are too high. And in addition, for taxable investors, they're almost always put in structures, just going back to our conversation before, they're always put in structures that are tax inefficient. So LP structures, which are taxed at ordinary income. And so our thought was, could we use technology to understand how managers were positioned, the most sophisticated managers in the world. If you could infer how they were positioned, you could then take that understanding, translate it into long and short positions, and package it in much more tax efficient structures that are available to every investor, in particular in the ETF structure. And so that's really what I've been focused on over the last couple of years, is basically challenging the hedge fund industry, the venture capital industry, the private equity industry, in terms of using technology to basically replicate how their returns are coming out, and then making that available to everyone, much more cheaply, much more tax efficiently than what exists today.
Kevin, do you have a question for Bob?
I do, Bob. So as we try and democratize alternative investments or hedge funds and bring them to the masses, how much gets diluted or watered down when we try and fit everything that a hedge fund generally tries to employ into a 40 Act ETF, as you just mentioned there? Can the investor still experience the same type of returns, the same type of risk mitigation techniques within an ETF that they could if they just invested in the hedge fund directly themselves?
Yeah, it's a good question, and a common question when people are thinking about essentially that trade-off between a replication versus investing directly in the funds. And when you think about that question, one of the things that you can do, you can't capture all hedge fund strategies in an ETF wrapper, particularly high frequency, liquidity providing strategies. So Rentec, not in an ETF. But if you think about it, the hedge fund industry is $5 trillion of assets. And if that's the case, then basically hedge fund managers in aggregate are taking directional positions in the 60 or 70 most liquid markets in the world.
Right.
And those directional positions can be implemented using highly liquid securities, futures contracts, exchange traded, index funds, things like that. And so the reality is you can get, let's say, 90% as good in terms of the quality of the views as if you invested in all the hedge funds, which you can't do practically, right? In an ETF wrapper. But the key thing to remember is if you can do that, but you pay a quarter of the taxes, a quarter of the fees and half the taxes, then no investor cares about the gross of fees returns of any investment strategy. No one cares because they don't see that. The manager sees that, but they don't see that. What they care about is net of fees, net of taxes, net of advisory fees, right? That's what they care about. And so what we're doing is we're creating something that's a pretty darn good representation of those strategies. And then when you add in those other elements, those other saving elements, in many cases for investors, you have something like a 90% probability of outperforming, an individual manager selection over a short time frame, given the fee savings and the tax savings.
Let me ask you this, because the world of investing right now, I've been in AI now almost 2 years. And at the first AI firm I was at, we were very heavy into data chunking and indexing in order to allow people like you to ask a natural language query and get almost immediate answers in easy to understand language along with the sourcing. But what I learned in that process was the answer is only good as the database from which the secondary financial tool is allowed to access. So where do you see this heading? Because I'm hearing people say that AI will put individuals like you or your businesses out of business. And my experience is that, no, it's a tool for your businesses. I don't think it's going to put anyone out of business just yet.
Well, I think when you're thinking about AI, there's sort of a challenge with a lot of investing related activities related to AI, which is, AI is particularly good at high quantity inference. So for instance, take all the written words in the English language and use that in order to, essentially, and use that to predict what the next word is in a sequence. Okay, well, that's a huge volume of data to create inference on. Or how do you learn how to pick out pictures of cats? You look at literally billions of cat pictures and then you learn, right? When you think about financial markets, the reality is that there's been like 8 cycles in the last 100 years. Well, 8 data points essentially is not particularly useful in terms of trying to draw AI inference. And even if you start to talk about, let's say, the hourly or minute performance of every stock in the S&P 500 in the post-war era, that's still a tiny sample size. And so what that highlights is you need people, frankly, who are not so reliant on data inference to build investment strategies and manage investment strategies, and frankly, visualize the impossible, you know what I mean, in terms of how things could play out, in order to successfully run money. And so these strategies, these AI, I call them more like techniques. And if you've been in this business for long enough, particularly as a systematic investor, you see these AI strategies today, and they just are just another tool along the path of different analysis tools. But at its core, the only way to manage money successfully is you have to have a person with deep expertise, deep understanding, bringing their common sense framework to thinking about how the world's going to work and applying that in a way that's rigorous, but also imaginative.
I got as a favor to Julia LaRoche, who is a buddy of mine. We work together at Yahoo Finance, and she has a very successful podcast, the Julia LaRoche Show. You should go to YouTube. You should subscribe. You were just on it in February, and she gave me permission to use a soundbite from that podcast because you called out, you called something, and we're living it today, and it had to do with expectations for 2025. And here is what you said to Julia.
If anything, the policy mix, both from the Fed and from the new administration, look less positive than I think many people expected. And so when I see that, that combination of dynamics is teeing up for a likely growth disappointment through the course of 2025. And we're probably going to see a reversal of that environment where, the last couple of years, stocks radically outperforming bonds. Now, we're likely to see a flip of that as we go through 25.
Bob, do you see a world in which AI could have made that kind of statement within the next year, or is it way off?
Oh, I think that sort of level of inference, which I know seems so obvious. I mean, it certainly seems obvious sitting here today relative to where we were at the beginning of the year, because that's what's happened. I think it wasn't obvious to 95% of forecasters of the S&P 500 at the end of last year. Like that's not an easy thing to draw that inference, and particularly thinking about it in the context of there's just like not a lot of sample size of that. Like that required an understanding, some data in terms of expectations and understanding that, but required imagining a world of what could play out and all the linkages that it could occur. And I think we're very far away. I mean, I've seen people work on this, try and create, frankly, like macroeconomic models out of AI inference. And you constantly run into, first of all, consensus thinking, which is challenging, right? Because in order to generate alpha in markets, you can't have the consensus thought, you have to have a non-consensus thought. So that's one of the problems, which is inference on the consensus. And number two is failure of imagination and just, things that they have not, like, for instance, here's a very simple example. Like, how would you know if you were an AI, what the impact of, the new administration coming in and restricting immigration would be? The sort of immigration restriction that we're seeing transitioning from the previous administration to today is the most radical shift in immigration policy that has existed, in hundreds of years in the United States. Okay. Where's the data? Where's the inference? Where's the conversation about that? How are you going to figure that out? I think that's the challenge that these sorts of processes have if sort of left to their own devices. But what I would say is, I mean, even our approach to infer hedge fund positioning, it is leveraging machine learning techniques that were not available 5 years ago and were not, economically viable from a compute perspective 5 years ago. So you could use the tools, but they're just tools. You have to have them guided by people thoughtfully using them in the right way.
Kevin?
Yeah, I think if I could just jump in here real quick, from Bob's example, we started this year looking at historical data and analyzing massive amounts of historical data That's a very primitive form of AI, if you will. And what we found was that going back to 1950, there had been 9 previous times when the stock market rallied by 20% or more in consecutive years, 2024, of course, being the 10th time. What we found that was comforting was that in 90% of the time, the market was higher the following year. Perhaps what wasn't so rosy was that it was only higher by an average of 3.6%. So that told us maybe we shouldn't be expecting as big of a year in 2025. But our clients don't want to hear that. They want to hear, how can I still outperform in that type of environment? And that's when I think machine learning and artificial intelligence can help us to analyze different periods when these factors are in place to help identify what areas of the market may provide with those alpha opportunities, just as Bob's explaining before.
Bob, where are those opportunities right now? Can you share with us what you might be seeing from the tools you're using?
Yeah, well, I think the biggest thing right now, particularly if you look at professional money managers, hedge fund managers, is this is a time of low conviction, and that's important because in order to generate high quality returns over time, you have to know there are times when you have confidence in your views and times when you don't have confidence in your views. And this is a period where very aggressively you should have low confidence in your views. And so, I mean, just look at the tariff situation, right? We went from 25% in the last 6 weeks, we've gone 25% tariffs on Canada and Mexico to 0 to 25 to 0 to 25 on the most important products, right? Like, you know, unless you're somehow in the mind of the fella in the White House, and you know, like, how are you ever going to trade markets based on it? Like, it's impossible. It is literally impossible. Anyone who says that they can trade markets in this environment based upon, you know, predicting policy or whatever, they don't know what they're talking about. And so that's the biggest thing is it's a low conviction environment. And then I think the second sort of overwhelming thing that we see is that the risk of a set of negative growth policies has yet to be fully priced in to the market. You know, the stock market's down a little bit from peak, down 10% or a little less than that now. But the reality is we're still at the same levels as we were at the election point. And I think the policy mix has turned out to be less pro-business than certainly was hoped for, and less, at least in the short term, pro-growth than was hoped for. And what we're really seeing is a series of negative growth policies in the short term. You can argue whether it makes sense in the long term, but in the short term, it's pretty clear. And that really isn't priced into stocks or the bond market at current levels.
I'm going to go into the Brady Bunch slate, as I call it, because we're going to have a 4-box now. We're going to bring David Wilson back in because I'm sure he wants to join the discussion and ask Bob some questions. David, before I let you ask your first question, I want to just follow up with what Bob just said, because I am the least qualified of the people here. I'm kind of the Dollar Tree. I can turn your $9 billion into $1 billion real quick. So what I just heard you say, if I understood, Bob, was I should be sitting on the sideline right now in cash, maybe have some funds in short-term treasuries, maybe even 1 year. But, you know, as Kevin said at the beginning of the show, we haven't hit the low yet, and I should be waiting to jump back in. That's what I heard you say. Did I get it wrong?
I don't know if Bob said to go to the sidelines. Did you, Bob?
Well, what I said is this is not a time to go all in on a view, right? And so actually, if anything, what that means is you should be more diversified, right? So I think the risk is there's been a real lesson over the last, you know, really 15 years, which is like stocks go down 10%, buy the heck out of them. And, you know, go all in. It's a good time to double down. And I think what those professional managers are saying is like, it could be a good time or it could not be a good time, but it's certainly not, your confidence in that has come down a lot about how that'll play out. And so given that, you know, stay liquid, stay diversified. Don't go all in on a particular view because, you know, that might change in a 24-hour time frame.
Retweet.
I got to say, you know, David, by the way, is the one who's going to bring home the gold because he was in the Olympics in 1996. He represented Guam in the Atlanta Olympics. But, you know, what would you ask Bob as you're listening to this discussion? Because you'd have to deal with the tax consequences for your clients if they follow Bob's advice.
Yeah, I mean, on many points, we're so aligned here in terms of, you know, Bob's mission to bring greater access at lower fees and, you know, to bring alternative investments to the masses, right? and as well, we just see this up and down, from every business owners, people working in tech, and the rest of the client base in terms of the confidence and sort of the disappointment in the administration around being pro growth and pro business. I do think that, some of Bob's experience, there's something I've always just kind of, that we as we invest, but there's, over the last 20 years, alternative investments, at least on the PE side, have gone gangbusters, right? And so many companies are now private, and there's 4,000 companies that are public right now, and it's down 50% over the last 20 years. In some ways, in my mind, I think that creates a little bit of a floor in the public markets, right? As this money has to chase a fewer investment universe. At the same time, we have higher valuations, and it's a tumultuous time in the market. So I'd just love to get your thoughts on sort of this, this trend and how it impacts your thoughts on investing in the current environment.
Yeah, I mean, from my perspective, actually, one of the areas that that trend that you're describing, let's call it the privatization of capital markets, is probably most impactful is in the high yield debt market. It used to be, when you looked at high yield bonds, there was a lot of junk. Let's just be honest. If you go back 20 years, I mean, it was like real junky stuff. And today, if you roll up your sleeves and look at the fundamental conditions of those instruments and the companies and the term and all that stuff, in some ways, it's like the blue chip index, more so than it is the high yield index, because so much of the truly junky lending has been pushed into the private credit sphere, in the private credit area. And basically, if you're an issuer that can actually issue issue public market securities, you got to be in pretty good shape. And so that's actually one of the areas, whether it's there or even traded loans that you might see, like senior loan trading and things like that, where the riskiness of those assets have changed, the underlying riskiness has changed a lot, and where it may look like spreads have compressed a fair amount, which they're low sort of on a historical basis, but the reality is, relative to the credit quality, they're actually still a pretty good deal. And so, as a simple example, in a universe of very overvalued assets, what we see with hedge fund managers in particular is they're moving towards higher yielding, publicly traded corporate credit, because that is actually quite a good deal in this environment, relative to all the different things that are out there.
Kevin, I just want to let, we got 2,000 people watching us right now, and we're monopolizing the discussion. You can ask your question. If you're watching us on X, or if you're watching us on LinkedIn or on YouTube, just put your question into the chat and we'll get it in. But Kevin, I'm sure you want to get in on this. And what is your follow-up for Bob?
I guess my really follow-up is, in these types of environment, when investors should be diversifying, they should have been diversifying and employing the virtues of diversification all along. But we also know that many investors now have short-term CDs scheduled to mature that they likely bought over the course of 2023, 2024. And the natural inclination of a lot of retail investors, once those short-term CDs mature, and sure, they were getting 5.25% at a relative risk-free rate, but the market also rallied by more than 20% over the last years. How do we prevent those retail investors from trying to chase those returns, keeping them balanced, keeping them consistent with their risk tolerance? I know it's easier said than done, but how do you do that with your clients?
Well, I think the key question on that is creating a game plan you can stick to, and I think that's the hardest thing. And it's not just create the game plan, which is super valuable, but also that you can stick to, right?
Right.
And so I think the challenge is that people kind of got off their game plan, and this is really, this is what advisors, I'm sure. Lots of the advisors I talk to, you're like part, financial engineer, a tax engineer. You're also like part, mental health support to the
psychologist, sure,
right, and part therapist, money therapist, and so part of that is I think the issue is, in times, you can't have the conversation about diversification, at a time when it feels like you're paying a huge price for diversification.
Right.
You want to have the conversation about diversification and lay out the plan, when people are receptive to the idea. And I think that's one of the challenges, is that so many people didn't have that conversation, tried, over the last couple of years or before the last couple of years, tried to ride the wave, and now, they're stuck basically in that circumstance. And so, ideally what you have is it sounds kind of boring, but even from a hedge fund guy, it's like, what you should do is dollar cost average, buy a diversified portfolio, and never look at your statements. That's what you should do. And you should do that for 40 years. And if you can if you can save 10% of your income that way for 40 years and max out your 401k and, invest in a tax shelter for college costs and stuff like that, like, you're going to do great.
Well,
that's right.
I interrupted you, Bob. Finish your thought, and then I got a question along these lines for David.
No. I mean, that's what it is. It's just, and I'd say the key element of that is to not look at your statements. I in fact, I'm a professional investor. Obviously, I can trade whatever I want. In my long-term savings portfolio, I have a deal with my financial advisor, which I have in order to help, basically insulate myself from myself. That I get to trade one day a year. It's usually the Wednesday morning before Thanksgiving, because nothing else is going on. That's the one day of the year,
right?
That I get to trade. I happen to luck out by buying inflation index bonds at 3.2%. The Wednesday before Thanksgiving during the financial crisis, which was my greatest trade ever. But that was sheer luck, because it just happened that one day was the only day I could trade. And so that is, take it from a professional investor. Even I need guardrails on my, long-term savings portfolio.
I'm going to throw this question out to all three of you, but I want to start with David on it. And I ask it from the perspective of I don't have the experience the three of you have. I mean, I'm in kindergarten compared to your PhDs. But here's the question. I listen to all of this, and I do believe in diversification. But if, as we know, the cycles are such that you want to be in the equities, why wouldn't you just, what was they used to say in the 90s, set it and forget it, Ron Popeil? Put it all into, forgive me, but the Vanguard Index 500, walk away for 30 years and call it a day. Why wouldn't you do that, David?
Yeah, I think that for some people, they can do that, right? And so if we all knew the timing of how long we would live and what markets would do ahead of time, well, then, yeah, that'd be a great strategy, and we would just maximize equity. But for a lot of people, they just can't handle the volatility as well. We go through the sort of the life cycle of people. They might be they'll have saving for college, and then they're paying for college, and then they're might want a second home, and so those liquidity events need to be timed with their portfolio. And then, of course, in retirement, well, then they want to draw down their portfolios in the most tax efficient way. So ideally, to your point, that earlier question around a bunch of cash in people's accounts, Kevin, is that, yeah, so oftentimes we are saying, hey, like, you have this much cash and you should be reallocating it and sort of dollar cost averaging it into the markets. Because even in a tumultuous market like this, most people are up because Europe's up, bonds are up, and it's the U.S. markets. And so, like, when people ask me how the markets are, I'm like, which market are we talking about?
Right.
I got a fairway. Kevin, I am curious, when your clients, that's a bad joke for people who live in New York, they get it. How do you respond, though, to your clients? Because all of you understand these things, but your clients are people like me who are like, what do I do? Now, fortunately, I listen to people like you, and I do what my advisor says. But how do you deal with, it's the mental health question. Because I look at what happened today. We saw the market sell off again, and it's as if it's a whim. It's today it's up, tomorrow it's down. Because all you have to do is say the word tariff, and people freak out. So what do you say to the clients? How do you keep them patient?
So you really have to get a good, solid understanding of what their true risk tolerance is. And obviously, if you look at 2024, 2023, the market was up by 26 and 25% respectively. They're going to tell you that they have a risk tolerance. Oh, but wait a second. What happened back in 2022, right? When the Fed was raising short-term rates dramatically over a short period of time, and the S&P 500 fell by over 18%. Oh, no, I don't want the S&P 500 then. I just want it when it's going up. Well, unfortunately, you can't do that. So what can you do to employ diversification to allow for a smoother ride over time to meet their longer term financial goals? If in fact they get unnerved when the stock market is down by 1% or 2%, or there's a new tweet about tariffs and the market pulls back, maybe they don't have a high risk tolerance. Maybe they should have a lower allocation to equities or the S&P 500 in general. If they're looking for income, I would argue that equities may not be the best place to turn to for consistent streams of income, and principal protection when held to maturity with a lot of investment grade bonds can tend to offer, or some alternative investment strategies. So you really have to get to know your client, be that psychologist, make sure they're honest with themselves about their risk tolerance, and then build a portfolio that will provide the smoothest ride possible to meet either their growth or their income objectives.
Bob, talking about the risk tolerance issue, there's also the patience and the tolerance for longevity, because we were talking about alternatives earlier. And one of the things that has me worried about alternative investments is you lock your funds up for 5 years. And if I can get a risk-free return with the U.S. Treasury, I understand inflation is going to kill me, but wouldn't that be the better bet than, say, the risk of an alternative investment, Bob?
Well, I think you're painting all alternative investments with the same brush. I mean, I think liquidity, what I'd say is a critical component and is often undervalued by investors relative to what they see as posted returns. And you're right. There are a lot of things, particularly private equity and venture capital, where, 5 years, you wish you got your money back in 5 years, at the current pace of distributions, you're probably not getting your money back for 10 to 15 years. Okay. Well, if you're not getting your money back for 10 to 15 years, the type of returns that would have to be achieved over that period would have to be very, very high in order to make that illiquidity worth it. And it's interesting, even in the hedge fund space, it used to be that, quarterly liquidity was kind of a norm in the industry. And increasingly, the big asset aggregators, the big fund names that are sort of in the public knowledge, are putting in lockups that can be as long as 5+ years. And so, and there again is a question of like, when do you actually need your money? I think in that context, the idea of how do you find good strategies and good returns that give you high liquidity, I think is pretty important. And really emphasize and really recognizing liquidity, because you never know when you need your liquidity. I mean, it's the same. It's in some ways the same exact answer as the question of why don't you put everything in stocks and let it ride? Is you don't know when you're going to get sick. You don't know when you're going to have a car accident. You don't know when the pipe breaks in your house. Like, you don't know these things. I mean, you kind of know when your kid's going to go to college. That's something that's
you hope
more knowledgeable. You hope. But there's a lot of life you don't know when you're going to buy a house. So you might say, I'm not going to buy a house for 20 years, and then get a new job, you got to buy a house.
So I'm going to bring this one last question to all three of you, and we'll go down the pike because I'm looking at everybody. I'll go Bob, David, and then Kevin. And it has to do with this issue of liquidity. And in the old-fashioned world, what we were just talking about, with fixed income, I'd be looking maybe, bond laddering would be one way perhaps to do this. But it's on the premise that the U.S. Treasuries are risk-free. And now we're in an environment where we have political leaders who are walking us up to the edge of default sometimes. And I'm not laying blame on Democrats or Republicans, but does the old, this is a risk-free investment still apply, or do I now need to be nervous about that? Bob first.
Well, U.S. Treasuries are risk-free. The yield that's on the bond is the yield you will receive no matter what. And there is certainty that you will get it. Default is not an option and will never happen. And I've studied this at significant depth, and it's just not going to happen. That doesn't mean that bonds are going to be a good deal. And the reason why that could be the case is because the yield could not compensate you for things like inflation and other aspects that either actually measured or realized in real life. And so increasingly what we see is folks are moving to include some gold in their portfolios. If you look back through time as a diversifier, gold is a better diversifier in stock drawdowns than bonds about 50% of the time. But essentially, no one holds gold and everyone holds bonds. And so I think increasingly we're starting to see signs that gold can be a high quality diversifying asset in your portfolio, not because bonds are going to default, but because bonds may not be a good deal from a long-term real return perspective.
David?
Yeah, no, I think for the vast majority of people, owning T-bills or with a big chunk of their portfolio probably isn't appropriate. Just given the purchasing power, diminishing over time. But if you're gonna buy a home in 18 months and you want to have that money there for sure, it's a lot better to have it in T-bills, so you save on the state taxes and than in a Marcus account, for example. But treasuries do have a use for some people. I think we do worry about the bond market in terms of the effect of huge deficits in the dollar. Like Bob's saying as well, that we for the right people, investments in gold can help, at least on the margin here and there, dampen volatility and kind of hedge against some of those risks. So.
And Kevin, take us home.
Yeah, I would say that the United States government cannot and will not default on our debt, because even just missing a coupon payment or not being able to service some of our outstanding debt would have devastating consequences to us in the capital markets. And I believe that both political parties understand that. However, we did experience some credit rating downgrades because of our two political parties' differences with respect to the debt ceiling and raising the debt ceiling and what happens each time that debt ceiling debate takes place. And we don't want to get into the minutia of how the sausage is made here, but we have a lot of differences in this country politically. But overall, the overarching goal is to keep the United States as that shiny sitting on top of the global economic hill. And I wouldn't be concerned from a default perspective with U.S. Treasury securities, but of course, at what price and at what yield? And should you diversify beyond U.S. Treasuries and consider U.S. agencies, investment grade corporate bonds, and municipal bonds as well, if you're looking into the fixed income side of the world?
And the good news for all of us is that the people who orchestrated the $9 billion purchase of Family Dollar when Dollar Tree did that many years ago are not in the U.S. government today. So perhaps there is reason for hope. I want to thank all of you. Bob, Elliott, it was a pleasure to meet you. And I'll say hi to Julia LaRoche and I are going to catch up tomorrow. David Wilson, thank you. And Kevin Mon, always a pleasure to have you here. I hope all three of you will consider coming back to Talkenomics Live. We will see you next week, 7 p.m. live here from Brooklyn, New York. All the best to you.